We've heard a lot about this rate. So what exactly is this rate? Now, think of the neutral rate. Well, firstly, where do we get the neutral rate? Let's start there. So if we open up the most recent summary of economic projections. Now, this is the quarterly projections that the Fed or the FOMC releases to the markets, where they give their projections for various parts of the economy, where they think GDP is going, inflation is going. The more or most watched part of this release is always the infamous dot plot. Now, I'm not going to go through exactly what this is and how we interpret it. We do have videos on that in the video library, so do make sure to check that out. But what we get with the release of the summary of economic projections is a longer run estimate of what they call the neutral rate. Now, think of the neutral rate as the rate at which the Fed thinks monetary policy will be neither stimulative nor restrictive. So think of it as the rate that they think they need to reach to get to like a sweet spot for interest rates, the level where rates shouldn't really assist or restrict the economy. It's the rate where they think they will be able to, in the medium term, in the longer run, be able to reach their mandate of maximum employment and stable prices, right? So it's their sweet spot rate that they think. Now, what's important about this rate is that it's always changing. And so it's not set in stone. It's not something like a inflation target that's normally set at a specific level, at a specific percentage. This will change based on how the FOMC judges the economy and where they think rates will be going as a result of that. So when there's major things in the medium term that's implicating growth, they'll obviously change their longer run estimates of that neutral rate. So they take many things into account. They've got many models. The most popular model that they use for that is called the R star model. You guys can Google that to get some more information on that. But they've got many different ways to analyze it, to model it, to try and get to what they think should be the neutral rate. So it changes from meeting to meeting, or from a release of the summary of economic projections, from release to release. So here we can see Fed's Williams today talking about the neutral rate, saying that he thinks the neutral rate is between 2 and 2.5. We need to go a bit above the neutral rate depending on inflation. We also heard from Waller yesterday, who of course said that he wants to get above neutral by the latter half of this year. So Barkin's saying that he think there's a likelihood that they'll need to go beyond neutral, adds that should move rates rapidly to neutral, then tighten further if needed. We also had comments from Evans, appropriate to move towards neutral rates expeditiously, obviously much faster. So when we hear all of these comments coming out from Fed officials that they think they should get to neutral by the end of the year, think about where we are in terms of rates right now. We are currently in their target band between 0.25 and 0.5%. So if they think that they should get to neutral, which right now is estimated at 2.4%, by the end of the year, which some of them said, that means that they will be essentially increasing rates by about 200 basis points before the end of the year. So a very aggressive move, right? Some of them said that if we can get to neutral by Q3, which is very aggressive, they would be happy by that. So that's what they mean with neutral rate. Now, the one thing that's just important to keep in mind about the neutral rate is that the Fed right now, the Fed thinks the neutral rate is going to be 2.4%, but like we said, it changes all the time, and we need to understand that even though they think neutral is 2.4 and they'll get to neutral, where we are right now, things can drastically change in the next 3 and the next 6 months. We can see neutral rate being much higher or much lower in just a scope of 3 or 6 months. Now, a good example of that was what happened back in 2018. Now, for those of you who are not familiar with the 2018 cycle that we had, if we just quickly go back to the daily, if we go to 2018, you'll see that we had quite a tumultuous year for stocks, a massive amount of downside in that fourth quarter of 2018. And what was happening in this environment is we had a very, very hawkish Fed that was expected at this time of the year to hike rates, to stay very aggressive, actually even longer than that. In this area over here, they were still expecting to go very aggressive on rates, still expecting to hike maybe 3 or 4 more times going into the next year, which was 2019. Then suddenly the stock market collapsed. Suddenly they realized, wait a minute, but growth has actually been slowing for the past couple of months. And then they pivoted more dovish, which was coined as the Fed put. So why this is important is I wanted to show you guys how the expectations from the Fed changed in a matter of just two summary of economic projections, right? So keep in mind where interest rates were at this time. They were above 2%. They were expecting in this box, they were still expecting rates to go to raise rates another 4 times. But obviously, equity markets tumbled because equity markets saw that growth was busy slowing. Now, if you take a look at this chart, what I've done is I've basically taken September 2018, December 2018, and March 2019. So all 3 summary of economic projections, right? And what you'll notice is how drastic the summary of economic projections, the estimate for the neutral rate, how it changed just in a matter of 6 months. We started at 3% in September. That went to between 3 and 2.7. That was the median. So just below, let's say actually closer towards 2.9 by the looks of it. And then that dropped all the way down to 2.5, all in a matter of 6 months, right? That's a big difference, half a percentage point. That's 50 basis points of less tightening expected. Now, what you'll also notice is see how the growth picture drastically changed, right? They were expecting, back in September, they were expecting 2019, that was the year after, obviously. They were expecting 2019 to hit 2.5. 3 months later, that was 2.3. 3 months later, that was 2.1. Look at the 2020 estimates. That was estimated at 2, then at 2, and then suddenly downgraded to 1.9. So you can see how very quickly the estimates for these things can change. And that's one of the things that the market is often so frustrated with with central banks with, is that they seem to miss the obvious signs that many market participants notice. Now, sometimes they might be missing those signs on purpose. We'll do another video for that on another day. But what's important here to understand is that when you look at the neutral rate, even though there's a lot of talk about it, it's important because they set policy based on it and where they think policy will go. But it's also very important for us to understand that what that neutral rate is right now, depending on how the situation evolves, you can be looking at a much, much, much different number in the next 3 and the next 6 months. So hope that explains it. Also why it's important for us to track it, because it is important in their decision-making process. But again, this is a very good and sobering example of, even though they might think it's going to be 3%, 6 months later, you could be 0.5%, maybe even 1 full percentage point lower. So it's very, very important just to keep in mind that it's not something that's set in stone, even though right now, based on the most recent update, they think it's 2.4%. It might be much lower. It could even be higher in the next 3 and 6 months. So that's always just important to keep in the back of our minds as well.